Okay, thank you all for joining us today. We are going to go ahead and get started. We have a lot to go over with you guys, so we want to make sure we have lots of time to cover everything. For today's session, we're going to talk about accounting terminology. My name is Trisha, and joining us today is Alicia. We are both partners here at Fourlane. So before we jump into our topic today, I have a couple of reminders for everyone. We do have a YouTube channel, so if you've missed any of our webinars in the past, you can always find them on our channel at youtube.com/Fourlane. Also remember you can subscribe to our channel. That way you get those notifications as soon as a new video is uploaded. You can also connect with us through Facebook. Our Facebook group name is Fourlane QuickBooks Enterprise. We get asked lots of questions on that page, so there's always lots of great information that we're sharing, so please feel free to join that group. I also want to remind everybody about our on-demand support that we offer. It's $25 per QuickBooks user per month for up to 5 users. The price drops to $20 per month for 6 users or more. And how it works. Once you guys get signed up, whenever you need help, all it takes is a simple email to our help desk, just kind of giving the details of what's going on. We'll get back to you within an hour to set up a meeting so we can go over with you what that issue is. So please reach out if you'd like more information on the support plan. And then, of course, as always, post any questions you have and we'll work through them at the end if we have time. If we don't, we'll follow up with you at the end of the session to make sure that your question is answered. Okay, so for today, as I told you guys, we're going to talk about accounting terminology. So we want everyone to walk away from this webinar knowing it's not so scary when someone's throwing out words like assets and liabilities. So we're going to start off. I know. It is. So we're going to start off talking about the most commonly used financials, our balance sheet, and our profit and loss, and what makes up those reports. So Alicia, do you remember back in the days when you first started learning accounting and they taught us assets equals liabilities plus equities?
Oh, I do for sure. Yes.
Do you remember when we used to have to do T-charts and figure out our fund debits and credits?
I feel like, I mean, even though we use QuickBooks all the time, in my head when I'm like trying to work out things, or sometimes on paper, I will admit, I will bust out those T accounts and I will, make sure that I have it right before I like tell something to a client. But oh yeah, absolutely remember this.
I do the same thing. Well, our balance sheet is what makes up these 3 accounts. So when we talk about, what is the balance sheet? So our balance sheet is a business assets, such as our bank accounts, our equipment. Then we've got our liabilities. Those can be our credit cards, our bank loan, and then our equity. And that represents the health of a business. So each balance sheet account has its own register, and you're able to track the transactions involving the accounts and their balances. So let's kind of jump into QuickBooks and let's break down, take a look at our balance sheet. So Alicia, you can see here we've got our balance sheet. We've got lots of accounts, lots of balances. So talk to us and tell us, how do we get data onto that balance sheet? What's our starting point?
So, when clients come to me and they're like, hey, I just started my business. I don't know anything about accounting. I don't want you to talk to me about accounting. I just need you to help me set up my books. I try to make it as simple and fun as possible because not everyone is that accountant. Not everyone likes to talk accounting terminologies. And so I would say, right, before I can even go look at my balance sheet, you've got to create a chart of accounts. If you don't have the chart of accounts, when you go to record transactions, right, transactions are the things that we do as part of our natural business. But as we're recording those transactions, that's how we get things to appear. That's how balances are going to start showing up on those financial reports. So the chart of accounts is really our first stop, right? It's the first thing that we got to go do and make sure that we have this set up correct. Because if we don't, then our financials, that balance sheet that you showed us a while ago, isn't going to have much on there or tell us much of anything. So a chart of accounts, which also us accounting people will call it COA. So for anyone out there that, non-accountants, right? What the heck is a COA? It is chart of accounts. And I like to just explain that as a list of accounts used for recording transactions in a company's ledger. So think of it as a filing cabinet. I'm sure we all have filing cabinets somewhere, right? So it's a filing cabinet for your business's accounting system. It organizes transactions for us into groups, or we could call them categories. But Trisha, if you kind of show everyone the types there, that is where we're calling it groups or categories, right? Things like that. And those are the chart of account types. So QuickBooks has their own predefined. You don't have to make these up, right? Some other softwares you may have to make some up. You do not in QuickBooks, but this is where you can really, as a business owner, say, I'm going to figure out where my money coming in goes and where my money going out goes, right? Where am I going to record those things? Okay. So hopefully this is helping. So I'm going to talk first about asset accounts, because asset accounts, if we look at that balance sheet, right? That's the very first kind of section. So assets, those are accounts. Let's go back to using that categories word, right? Asset accounts are categories within the business's books that show the value of what it owns. Okay. So if I am going to receive money from a customer, I am going to debit an asset account. It is going to increase my bank account. And if I was to give money to a supplier, it would credit and reduce my asset account. So, we go back to that equation, right? So increasing my assets is a debit, decreasing my assets is a credit. But at the end of the day, my asset accounts kind of tell me where my business is standing, like how much value do I have? So some examples you have on this balance sheet, and some, normal assets, bank accounts. Like to reconcile those bank accounts as an accountant every month end, by the way. Accounts receivable, we've got things like prepaid accounts, inventory accounts, fixed assets. I will say one of the things that I like to say to clients, I think this is the easiest way to remember it. All the things that a business owns that I could sell today and turn into cash, that should be sitting in these asset accounts. You think that helps?
Yeah, that actually does help a lot. When I think about if I didn't have an accounting background, that really makes a lot of sense. So one of the things that kind of stood out that you talked about when it came to the bank account is the word reconciliation.
Oh, yes.
Yeah, so let's talk about what reconciling is. So an account reconciliation is when we go into our account And what we're doing is we're comparing our internal financial records against a monthly statement, such as a bank statement, a credit card statement. You could have a loan statement. And our goal is to make sure they match. So everything that is on that statement, it is in our accounting file.
Mm-hmm.
So if I was a client and I said to you, Alicia, I still don't understand. What's the statement versus what's a reconciliation? What would you tell them?
You know what I was going to tell you is like, I've had that. So a bank statement is, right, we log into the bank. I'm going to say this more as in like, instead of getting it in the mail, but you could still get it in the mail. But you log in online, you go to that, bank account, and you see your statement. Your statement normally is available a day or two after the end of the month, or whatever your like credit cards, like American Express, sometimes those don't end exactly on the last day of the month. But it's that financial institution that is providing you with a statement of money coming in, money going out, and it's netting to, right, like a new balance. So if we have an American Express card, right, you charged $10,000, you paid zero, you owe me $10,000, says American Express, right? My bank account, like here, my beginning balance was zero. I have deposits of $8,000. I have checks of $4,500, right? And so it's telling me my cleared balance is 35, kind of over there in that bottom section. So I reconcile in my system in QuickBooks here. This is the reconciliation, and this reconciliation ties to that financial institute's statement, right?
Perfect.
So there's two different things there.
Okay, I like it. I like it. Okay, let's flip back over to our balance sheet. So we've talked about our different assets accounts when it comes to our bank account. We've talked about other current assets. There's also fixed assets that you see on a balance sheet. And our fixed assets are long-term assets that a company has purchased and is using for the production of their goods and services, whatever they're providing to their customers. So these accounts are considered non-current assets. And what that means is that asset is going to have a useful life value of more than a year. So kind of some examples of fixed assets are property, your plant, your equipment, so your laptops, your computers, could be your phone system. So they also refer to them as tangible assets, meaning they're physical assets. So when a company is looking at their balance sheet, that's one of the things when they talk about how a business is doing, and that's something that is a physical asset, it's part of a company's business.
Trisha,
Okay.
I know that I'm on here, but I know you're leading, sister. I am going to, I looked at the questions while you were talking, and I want to see if we can go back to the chart of accounts really fast, because we've got a really great question, if I could talk over here. The question is, do you have the ability to edit existing account type names or add additional ones? So I'm looking at your screen, and to the right of it is where that type is. And I know you showed it in a different view earlier when we went to create new. But the answer to this, and I might have answered it earlier, but I want to circle back. The answer to this is no, you cannot change or rename the account types that are in QuickBooks. So if Trisha, you go to control new, and we basically go in here, these are predefined. There's no option that allows for me to say create new. I will tell you that it is really nice that you can't go create all these different ones because I've seen from other softwares where it's like COGS, cost of goods sold, like lots of S's in there, in some kind of,
Expenses.
yeah, made up names, like that's what I was
Yeah.
saying, made up names, right? And so in QuickBooks, this is the standard chart of account types. It's really nice that they are predefined for you. The one thing that you can do, right, because this is just the account type. This tells it on my financial reports where to show up. Now, if I want to add an account, right, I can call it whatever I want. So if we go back to that chart of accounts and we look at the 12,000 other current asset, that is a header account, and then I have subs underneath it. So we organized this in a manner that we wanted to see, even though the balance sheet format is already predefined in QuickBooks for us. So we do have a webinar out on chart of accounts as well, but we can always do some more, but it's a super great question. So if you want certain things like other current asset, like headers, you can structure it this way, but you do have to use those account types that come standard defaults inside of QuickBooks. Now, another question, Trisha, I'm going to put you on the board.
Okay.
This is, how would you recommend recording a loan receivable as an AR or a separate asset type?
For me, I would do it as a separate asset type. I recommend with clients that unless it is necessary for us to have more than one accounts receivable type, that we only want to have one, because then you run into a situation where when you create an invoice, which is the money your customer owes you for providing that goods or service, you're going to have to choose your different AR accounts, and then that leads to the possibility of human error. So I would create it as a separate asset account, and that way I can manage those dollars and those transactions in its own section.
Awesome. Okay. I know that we were talking about fixed assets. I hope that that answered y'all's questions. If y'all have any more questions, feel free to put those in. We will get back to those as soon as we possibly can. We are just having fun with this topic. And so if we don't get to them before the end of the webinar, we'll definitely get back to you for sure. So you were finishing up on those fixed assets, right, Trisha, before I interrupted you? All right.
I was. So kind of our main, to me, an asset account that we use every day, I kind of talked about it, is accounts receivable. So let's kind of talk about the different types of transactions that you would normally see in accounts receivable. I know I mentioned an invoice. So an invoice is money owed by the customer to the company for goods and services provided. Another type of transaction is called a credit memo. And this is where, we could possibly return goods. We're providing them a credit on services provided. So this is money owed to the customer from the company. And then once we've performed the service, our last option is the customer payment. And so what a customer payment is the money paid by the customer to the company for those services or goods provided. So I've got up here in our sample file the outstanding accounts receivable. So this is what we're expecting monies to be paid. So Alicia, what is the normal balance that you should see in your accounts receivable account?
So I was answering a question, but let me answer your question, because I know I gave this answer and I'm sure everyone on the webinar is going, I got it. But an asset, which is an accounts receivable account, has a normal debit balance.
So kind of going back what Alicia explained, an asset is, what that positive result on how a company's doing. And so in this example, the company is expecting to get $19,000 in money towards their asset. Okay, so we've kind of talked a lot about assets. How about let's flip over and let's talk about our liabilities. So coming on down here to our liability section, so let's talk about what a liability is. So a liability account is a general ledger account in which the company is recording things like any kind of debt, any kind of obligations, customer deposits and prepayments. It can be used to record deferred income taxes. So kind of, Alicia, talk to us about some different types of liability accounts that you've set up for your clients.
So there's a lot. And I know we've got that customer deposit one on here, but let me just say those most commonly ones that I've used. So accounts payable, hands down, number one. It's probably, like if you're in business, unless you've got all the money that you need to pay all the bills, right? Like you or operate on cash basis, but you most likely have accounts payable, right? Accrued liabilities, an accrual is something where we are trying to capture those dollars, right? We haven't paid it yet, but we know that we owe it, right? And so that's accrued liabilities, also not recorded in accounts payable, so it would be outside of that. You've got the customer deposits. Oh, payroll liabilities, right? That's a good example. Any kind of notes payable, like loans, loans that we've got to pay back. Unearned revenues, that could be one as well. So I think those are really some pretty kind of standard. Oh, let's just go ahead and add in here. So we were talking about the chart of account types, right? And credit cards, so American Express credit card, Visa credit card, right? Those are things that would also be found in this section as well.
Okay, so one of the things that you talked about was deferred revenue, customer deposits. And so sometimes when we need to show movement or transfers of dollars every month, we use what we call a journal entry. So a journal entry is recorded in a company's general ledger. And you can see by my example, you're going to have the date that you want it to post in your general ledger. You're going to have your GL account that you want debited, your GL account that you want credited. And then you always want to use this memo field. You want to give a description on why we created this. So,
oh, for sure. And
yes.
Don't just put something that you think you're going to know forever and ever, right? Don't just put like, Trisha's, I don't know, Trisha, some food, right? We want to really be able to recall exactly what we're doing this for. And I know I interrupted you, but I'm going to give some examples. So things like, I know we've got about 6 minutes left, so just trying to watch that as well. But month-end close allocations, when we're doing things like maybe revenue recognition. So we would want to type into that memo, right, things that like, what is this month? November 2022, revenue recognition, right? Or if we are doing depreciation, we could do November 2022 monthly depreciation. So those are some things that we could use in that memo field and be able to truly track exactly what we're doing with journal entries. But I will say, I caution my clients, journal entries within QuickBooks right, are not needed as they may be in some other softwares. So use the transaction versus a journal entry because not everybody is the accountants, right? And so Trisha's talking about debits and credits, and so if we don't have to use it, let's go use a transaction.
Absolutely. So we've talked a lot about the balance sheet. I know we've got about 5 minutes left, so I don't want to leave out the profit and loss. Can't run a business without our profit and loss. So our profit and loss, it tracks our income. So the company's income, while the expense accounts are tracking what the company is spending. So these, unlike the balance sheet accounts, they don't have their own registers. This is a way that we can see how a company is it gaining or is it, showing a loss per period. It's also referred to, sometimes you'll hear the words P&L. So Alicia, can you explain to us kind of what's the difference between the accounts on the balance sheet versus the accounts on the profit and loss?
So, I think I am going to, and I'm going to do my best at like explaining this. I'm actually going to give this definition or this kind of summary example. All right, so income, as you said, it outlines like revenue and what a company has earned in a specific period, right? It also is going to tell me about expenses along with that revenue I've earned, right? And people talk about bottom line, right? So it also gives you the formula, right, of what a company's bottom line is, okay? So your income at the very top and your cost of goods sold, which is in the middle of this example, those represent why you're in business. What am I selling and how much it costs in order for me to sell that, right?
Yep.
So
Also referred to as our gross profit.
gross profit. Hopefully these definitions and terminologies are making sense to everybody. So, and obviously that needs to be a positive number because you want to be in business to make money. So any cost associated with providing, I'm going to talk about that cost of goods sold too a little bit more. So any cost associated with providing a good or a service is called that cost of goods sold, or you may hear of it as COGS, okay? And that's how you get that gross profit that Trisha was saying. So anything in the expense section, I like to explain this as this is what the company, like I call it like personal use of the company, right? Does that make sense? So expenses are what I have to pay for in order to keep my doors open. I've got to pay rent. I've got to pay the lights and the phone bill, right? So those are those expenses. So this is really kind of telling you, like, I am in business, I am selling X amount, I'm spending X amount, that's my gross profit. And then it costs me, in order to keep the lights on, the number of my expenses. Okay, and so then that's my net income, hopefully. So my profit and loss is really kind of telling me and showing me the picture. And my balance sheet is kind of telling me what's my value of my business. So money I'm making, my value. Hopefully that helps.
I think it did. I think you explained every section of that profit and loss in a way that, it makes sense. It's hard to, hear words like, revenue or gross profit, but you were able to explain it to him in a way that, for me, it makes total sense even if I didn't have that accounting background. Okay, you guys, we are at time. I know there's still some questions coming in, and we thank you guys all for joining us. We will get the questions answered. And of course, thank you, Alicia, so much for sharing everything. We hope each of you has a wonderful day, and just reach out to us for any ongoing support we can help you with.